It's less volatility than, unless you got an '08 kind of thing, but it's less volatility than the stock market. You put $10,000 into Google, goes up $30,000, might go down to 20, 30, and you don't have control over it. That's the other thing too that I like real estate so much. You have complete control over your properties. While as opposed to the stock market, you can do financial data and risk analysis all day long, but you have no control over it besides when you buy and when you sell. With real estate, there's a lot of things you can do. You can buy a property, you can fix it up, you don't have to do anything if you don't want to, that kind of thing. You can rent it out. So there's just a lot more flexibility that you can control, and I'm all about control, especially when it comes to investing. I do a little bit of both. I do invest in stocks. I do obviously invest in real estate, but real estate is my favorite because there's so many more benefits to it, and one of those is depreciation. So you're familiar with depreciation a little bit?
Fill me in.
Okay, so depreciation is when, say you buy a $250,000 property. The IRS says that over time, the building on that property will devalue. It's going to deteriorate. So over 27 and a half years, you can depreciate up to, I think it's 3.636% every single year off of the dwelling or building value. So if you buy a $250,000 property and your land is worth $50,000, but the building's worth $200,000, that cost basis is what it's called. They're going to take that 3.636% off of that $200,000 value over 27 and a half years. And this is only for rental properties as well. Say you do depreciate a $250,000 property and the value is $200,000, 3.66% I think comes out to like $7,200 per year that you can deduct from your property because it's depreciating. It's a tax.
As a tax.
It's a tax deduction. This is the cool part. This is what they call magic. So you say you make $200 per month. You net say $2,400 per year, and this is cash flow. You're actually receiving this every single year that you profited. But with your depreciation of $7,200 per year, take that difference. You actually, on paper, according to the IRS, you lost $4,000. So when it comes to filing your taxes, you can write that property off as a $4,000 loss. As long as it's under $25,000, it can't be written as a loss. Think of it as a benefit. That's kind of the whole thing on depreciation. So that's why they call it magic. You have 10 properties or you've got 100 properties and you're depreciating all of those, you're not going to pay taxes on it essentially unless you do record a loss.